The Capitalization Table: Shares and Ownership Interests in a Startup Company. The Capitalization Table reports how ownership of the company is divided among the various shareholders. Each owner is identified, and the holdings of all forms of shares and other securities issued by the company are specified, including common and preferred stock, options, and warrants. The vesting status of each security is disclosed, together with the future vesting schedule identifying when and how the vesting will take place. Shares, options, bonds, and all forms of investment contracts fall under the definition of securities. Shares can be structured in many different ways, but the two standard share structures used in technology startup companies are common stock and preferred stock, also known as preference shares. Common stock and preferred stock are not created equal, and we will discuss the differences between them in a later slide. Common stock is usually held by the founders and employees, while preferred stock is held by investors. Options are contractual rights to buy shares in future, usually at predetermined prices. There are two types of options regularly found in startup companies: incentive stock options, ISOs, and non-statutory stock options, NSOs. As we will see in a subsequent slide, ISOs offer a preferential tax advantage to the holder, but can be issued only to employees of the company. Bonds are essentially loans to the company, usually several years in duration, with flexible repayment terms that can be negotiated between the company and the lender. Bonds are often issued to public investors by large corporations, but the closest analogy for a technology startup would be a convertible note, a loan that can be redeemed or converted to shares. For an intriguing approach to financing startup companies, see the slideshow titled Startup Bonds. When raising finance from US investors, it's virtually impossible to escape the scope of securities regulation and avoid the powers of the SEC. Although you may not be selling shares or bonds, any form of investment contract that involves an investment in a common enterprise with an expectation of profits is classified as a security and triggers the overview of the SEC. Entrepreneurs and their lawyers are keen to recognize when an investment agreement qualifies as a security, as the US federal regulation and the SEC's powers to impose sanctions are broad and continually growing. Entrepreneurs are obviously keen to avoid fines and potential jail sentences for securities violations, and failure to recognize a security is common grounds for legal malpractice. So this is an area grabbing the attention of lawyers representing startup companies. Common stock is issued to founders and employees, whereas investors usually demand stock with superior rights. The preferential rights are attached to preferred stock by contractual provisions agreed at the time the investment is made, and the stock is acquired by venture capital or other investors. Certain preferential rights appear in the vast majority of Silicon Valley-style startup investments. Liquidation preference, also known as participating preferred, defines how the common stockholders stand in line behind the preferred stockholders when the company is sold and proceeds are distributed to the owners. Before the founders, employees, and other common shareholders receive their pro rata share of the proceeds of the sale, the investors and preferred stockholders take a portion of the funds. The portion that is taken by the preferred stockholder depends on how much they invested and the terms that were negotiated at the time of the investment. Where the investment is substantial, it's not unusual for all the proceeds to go to the preferred stockholders when a startup company is sold. Entrepreneurs and employees are often surprised to find there's nothing left for the common stockholders to share after the liquidation preference has been applied and the investors have been paid out. At IPO, the preference shares convert over to common stock, usually at a 1-to-1 ratio, where one preference share buys one common share. However, if the company raises new money at a lower share price after the initial investment was made, an anti-dilution clause known as a ratchet can kick in, and this drops the conversion price, gives the preference shareholders more than one share of common stock for each share of preferred. The ratchet and weighted average are two of the most common formulas used to decide exactly how much more common stock the existing investors actually receive when new investment funds are raised. Instead of injecting their funds into the company in a single lump sum, investors may wish to provide part of the money up front and tie the investment of the balance to the company achieving a set of milestones. The investment is made in multiple tranches, tied to performance, and these provisions can be defined in the preferred stock agreement. Redemption rights enable the investor to force the company to return the funds invested when certain conditions are met. As with all these preferential rights, the conditions and the terms of the redemption can be negotiated between the investor and the company. Co-sell rights provide the investor with rights to sell their shares whenever other shares are sold and prevent the founders, employees, or other shareholders from selling their own shares independently. The preferred stockholders usually have rights to elect their own directors, and provisions are usually written into the preferred stock agreement defining how the board of directors of the company is to be structured. With these and other rights, preferred stock is obviously more valuable than common stock. As we'll see in a subsequent slide, the ratio of value of common to preferred stock is regulated by federal laws promulgated by the SEC. When the company goes through an initial public offering, selling shares to Wall Street and other public investors, the preferential rights held by existing venture capital and other private investors are effectively eliminated, and preferred stock is traded for common stock. Until the playing field is level at this time, and investors, founders, and employees all hold common stock of equal value, the difference between the two classes of shares can be substantial. At initial public offering, when the company registers with the SEC and sells shares to the public investors, preferred stock is converted to common stock, usually at a 1-to-1 ratio. Up to that point, management is able to issue common stock and options to new recruits and employees at a common stock share price that's below that of the preferred stock. As we discussed on the previous slide, the difference in value can be justified by the preferential rights attached to preferred shares that are not attached to their common stock counterparts. With a mandate to protect public investors, the SEC is concerned that management does not issue heavily discounted common stock ahead of the IPO, and the SEC sets guidelines to mandate how the common stock price compares to the price of preferred stock as the company matures. In view of the SEC guidelines, in the period immediately prior to IPO, the price of common stock awarded to staff is usually raised to at least 80% of the value of preferred stock sold to investors. At no point should a share of common stock issued to management or an employee represent less than 10% of the share price paid to investors. Management of a pre-IPO startup has to pay particular attention to the price of preferred stock and the possible offering price of the shares at IPO when pricing shares and options for employees. Ownership rights can be held in the form of options as well as shares. A share is an ownership unit in the corporation. Shareholders have rights to vote to elect the board members, rights to information on the company's performance, and other rights established by state corporation law. As we discussed on other slides, the rights of common shareholders can be somewhat junior to the rights held by holders of preferred stock. An option is a contractual agreement to allow the option holder to buy shares of stock, and usually specifies the number of shares, the purchase price, and the period of time in which the option can be exercised. An option does not carry the right to vote to elect directors or other rights conveyed to holders of shares of stock. Options can expire if they're not exercised within the window of time or in the manner specified in the option agreement. The holder of shares often receives a share certificate from the company evidencing the shareholding, but an option holder does not. There are two types of stock options commonly found in technology startup companies: incentive stock options and non-statutory stock options. ISOs are sometimes referred to as qualified stock options, as they qualify for a tax benefit in the United States. The holder can escape being required to pay ordinary income tax on the resulting profits from an ISO. If the shares are held for 1 year from the date of exercise and 2 years from the date of grant, then any profit made on the sale of the shares is taxed as long-term capital gains. Long-term capital gain is taxed in the US at a lower rate than ordinary income, so this is an advantage to the option holder. Options can be issued to consultants and non-employees, but do not qualify for preferential tax treatment in the United States. These are referred to as non-statutory options, or NSOs. The employee stock option pool regularly appears in the capitalization table of a technology startup company. It's become customary for startup companies in Silicon Valley and the technology sector to set aside shares for issuing as incentives to employees and contractors. A pool is created representing 15 to 20% of the company's shares, and an equity incentive plan is approved by shareholders, providing management with the ability to issue the shares and options within defined guidelines, but without requiring shareholder approval for each individual allocation. The shares are allocated and issued by the board of directors, following recommendation by management. The incentive is normally issued as stock options, but sometimes issued as vesting shares. The shares or options usually vest over a period of 4 years. The intent is to retain the employee for a period of at least 4 years. Vesting takes place at the end of each of the 48 calendar months during the 4-year vesting period. 1/48 of the shares, roughly 2%, vests each month. However, it's common for the shares to be subject to a 1-year cliff, whereby no vesting takes place during the first 12 months. If the employee leaves the company within the first 12 months, none of the shares will be vested. At the 12-month anniversary of the employee's hiring, 12/48, 1/4, or 25% of the shares vest. The whole year's vesting takes place on the first year's anniversary. Then vesting takes place monthly for the next 3 years. The number of shares issued to each individual from the stock option plan is governed by the terms of the plan that was agreed by the shareholders, but there are some customary guidelines defining how many shares are issued to the various managers and employees. For example, a CEO recruited following the raising of venture capital financing would expect to have sufficient shares that he or she would hold 5% of the company at the time of the IPO. To calculate how many shares that represents today, management needs to estimate how many shares will be likely to be issued to new investors between the hiring of the CEO and the IPO itself. Although it was commonplace in the high technology sector, the practice of backdating the issuing of share options for employees in order to select the lowest possible purchase price has been frowned upon in recent years. Backdating is now scrutinized in publicly traded companies post-IPO and results in serious sanctions for management. The SEC is not too concerned about privately held companies, so there remains some flexibility about how options are priced in a startup company. Startup founders, employees, and other shareholders may hold stock that cannot be readily traded. Various measures can prevent shares in a privately held company from being sold. In the bylaws, the company can mandate that the company has first option to buy back the shares when a founder or another holder of common stock wishes to sell. The buyback provision can be set at a predetermined price. If the shareholder is notified of the company's option to buy the shares, printed on the share certificate or in the share purchase agreement perhaps, the founder may be restricted from selling his or her shares to anyone outside the company, and the company may have the right to buy the shares at the predefined price. This can have a harsh result if the predetermined buyback price is much lower than the fair market value of the shares. The courts will usually enforce the buyback provision, even though it may seem unfair to the shareholder. As we discussed earlier in the slideshow, the sale of shares and other securities is regulated by the SEC. Before the shares are registered in the IPO process, US regulation prevents the shares being marketed to the public. The company bylaws can also restrict the way shares are sold, and stock purchase agreements can provide contractual restrictions. Pre-IPO, the shares of a startup company are evidently highly illiquid. Following IPO, the founders, employees, and other shareholders usually remain locked out from selling their shares for a period of time, perhaps 6 months or a year from the IPO, and sometimes longer. After the lockup is released, regular employees may be free to sell their shares on the public stock markets. But insider trading laws restrict when and how shares are sold by directors, officers, and other company insiders. So the capitalization table shows how the shares of the company are divided among the various owners. Common stock, preferred stock, options, warrants, and all forms of securities are identified. The fictitious Acmetech Startup Inc. table here shows the cookie-cutter style that is common in Silicon Valley. Like all capitalization tables, the sample Acmetech Startup Inc. table tells a story. After the company was formed, 10 million common shares and 20 million preference shares were authorized to be issued at a later date. Then some seed funding was raised from angel investors as a loan that was converted to shares when the Series A round was closed. Then 2.5 million common shares were issued to the founders, probably on a vesting schedule of 3 or 4 years. $8 million was raised in a Series A round of funding by selling 6 million shares at $1.33 each, a pre-money valuation of the company at $10 million. An employee stock option pool of 5 million shares was authorized and carved out for current and future employees. A $15 million Series B round was raised to fund the company through the expansion stage by issuing 7.53 million shares at a price of $1.99 each. This sets a pre-money valuation of $30 million. 1.55 million common shares options were issued to the new CEO at this point. Then a $20 million Series C round was raised to fund the company through the mezzanine stage by issuing 6.02 million shares at a price of $3.32 each. By this stage, the pre-money valuation had increased to $75 million. Then $80 million was raised at IPO by selling 5.72 million shares at $13.99 each. A pre-money valuation of the company of $400 million. All the preference shares were converted over to common stock at the IPO. Experienced entrepreneurs take care planning the capitalization table and forecasting how the shareholding of the company will evolve over time.